Hello, and this is Global Business Insight, where we look deeper at the headlines from a business perspective. China's consumer price index up 0.5% over the year in July after reporting a 0.2% increase in June and higher than growth of 0.3% expected. Producer price index dropped 0.8% year on year in July at the same pace as seen in June, which was above minus 0.9% expected. The data reflects an ongoing improvement in domestic demand as Beijing ramps up stimulus. Yesterday saw some relief as major US benchmarks were all sharply up after latest unemployment claims data eased fears of weakness in the labor market. US unemployment claims for the week ended August 3 was at 233,000, below the 240,000 expected, also easing fears of weakness in the labor market following last week's much higher than expected initial claims figure and weak non-farm payrolls report. JP Morgan Chase CEO Jamie Dimon commented that the US economy is not in a recession, also urging for calm as the week's market volatility continues to spook the outlook. Diamond does not rule out, however, the odds of a recession coming. Tech stocks climbed, but still the opportunity to buy the dip did not soften the skepticism around big tech's pivot to AI. Still, it was a strong end to the day in Wall Street as S&P notches its best day since 2022. European natural gas prices on Wednesday rallied for a third day, closing at 4.3% higher at 40.1 euros a megawatt hour, following fighting in Russia's Kursk region, home to a key gas intake point, stoking fears of a possible disruption to Russian fuel across Ukraine. The incursion is reported to be Ukraine's largest assault on Russian territory since Putin ordered the 2022 invasion. And Mexico's central bank cut the benchmark interest rate by 25 basis points, warning of downside risks to growth as policymakers grapple with global volatility and accelerating inflation. Earnings continue to come in. Eli Lilly announced higher than expected second quarter earnings per share amid growing sales of its weight loss drugs and raised its full year guidance. Meanwhile, Warner Brothers stock sank after it reported lower than expected second quarter loss and took a $9 billion write down on the value of its cable networks. Delta Airlines may be suing Microsoft and CrowdStrike after expressing frustration in a new letter after last month's massive global network outage. The US-based carrier claims it was forced to cancel thousands of flights because of the outage and had lost at least $500 million as a result. Barclays has become the first British bank to tell staff it will scrap the bonus cap imposed by the European Union following the UK's post-Brexit decision to remove the limits last year. US data watchers will look for producer and consumer level inflation figures due next week. Nigeria's CPI also out next week, Thursday. According to CME FedWatch, they see a 57% chance of a half-point cut in September, down from 69%, with still 100% agreement on at least 1 quarter-point cut. Seychelles, Mauritius, and Egypt were the top 3 out of 31 countries, and in that order, in the latest Where to Invest in Africa 2024 survey, which was released by the research arm of RMB, an Africa-focused corporate and investment bank. Welcome back. Our main deep dive focuses on Africa as we look at the 2024 edition of the Where to Invest in Africa survey released by the research arm of RMB. Rankings out of 31 countries help us see the good, not so good, and the plain ugly as far as attractiveness for investors is concerned. Seychelles, Mauritius, and Egypt are the top 3, and in that order, followed by South Africa, Morocco, and Ghana. Nigeria is ninth, also behind Senegal and Tunisia. The main criteria used were grouped under economic performance and potential, market accessibility and innovation, investment climate, and social/human development. If you discount the smaller countries with under 5 million population like Seychelles and Mauritius, we see that Egypt, South Africa, and Morocco and Ghana will be leading the table again in that order. But why is Nigeria so far behind, even though still in the top 10? A closer analysis of the data reinforces some of the familiar root causes. First is inability to reap a demographic dividend. Nigeria can reap a major demographic dividend if it can leverage its young population the way India has done. The alternative, if the young population are not scaled up and positively energized in small business enterprise, is a hub of chaos and divisions. Nigeria boasts 375 billion US dollars a year GDP and the continent's largest population, nearly 220 million people. Nigeria is first in population, now third in GDP size after a major currency devaluation, but still ending low on the investment scoreboard than its share market size would suggest. Economic complexity is another headwind. Countries with greater diversity of products and services produced are more attractive to investors. Nigeria scored low in this factor. Global connectedness is associated with international flows of trade, capital, information, and people. Nigeria also scored low. Innovation is sourced from the latest Global Innovation Index reports by the World Intellectual Property Organization dated 2023. Again, Nigeria is scored low. Also, a country that relies heavily on the import of a single commodity or a small group of commodities would be at risk in the event of a global supply disruption or price increases for those goods. Again, Nigeria is scored low on import concentration. Also looking closer, Nigeria's size and economic strength advantage is dragged down by indices showing poor market accessibility, inflation, high corruption ranking, and a very poor perception of political stability. Also rated very low by African standards is human development and social factors such as unemployment. Egypt, that leads the table for high population economies, is being closely mentored by the IMF in a program that helps market confidence. Egypt is also ranked very strong in human development, 5 out of 31. On market accessibility, they are also strong, first out of 31 on its economy, even though Egypt scores low in personal freedom. Nigeria on inflation is ranked 27th out of 31. On corruption, ranked 26th out of 31. On perception of political instability, it is ranked an abysmal 29 out of 31. And all these wave fairly serious red flags for investors that are much more risk alert than before. Nigeria needs a people and human development refocus or reset as it dramatically removes barriers to improve the investment climate. Diversifying the economy by stimulus for small and medium enterprises and young entrepreneurs will be expensive, but can be financed by privatization of state-owned enterprises like NNPCL and affordable lending support. I would not rule out more support from the IMF, but the vision of what needs to be done has to be so much bigger and more impactful in social factors, education, skills, and small business. The Nigerian finance minister said recently that they do not agree with IMF policies. The big question for leadership in Nigeria is how can strengths in a young population and GDP size be made to benefit the grassroots more as Nigeria aims to become a hot spot for investment. It has to start by admitting that while the potential is huge, it needs to move with a sense of urgency to address so many issues, many of them highlighted in this survey, granted that we have seen a decent start on many fronts. The Barclays Bank in the UK has followed the example of JP Morgan, Goldman Sachs, also in the UK, in telling staff it will raise bonuses. Barclays becomes the first UK bank to scrap European Union bonus caps, and this could lead to material risk takers being eligible for awards of up to 10 times their fixed pay without changing their base pay. This was the so-called JP Morgan model. According to Barclays Bank statement, they say it will allow greater flexibility to differentiate individual bonuses within a small and defined group of colleagues, and enabling Barclays to continue to compete effectively to retain and attract the best talent globally. I'm not a fan of capping bonuses. Indeed, if the board oversight is there to ensure bonus schemes are well developed, scorecards are fair and transparent, companies should be free to reward staff and executives in a way that focuses on their strategic objectives and enables them to attract the right talent. I also think bonuses and variable pay should be cascaded down the organization, not just for senior executives. EU staff will come under pressure, and we could see some moving into the UK. The change to the Barclays pay structure will affect the group's around 1,600 so-called material risk takers, which excludes bankers in Ireland or Monaco, as these are under the EU limits, but it will include bankers in other countries. Barclays also says generally the revised bonus cap should not change colleague expectations around total compensation. I guess that means it will not punish average performers, but will give the bank the capacity to pay stars significantly more. After all the worries about a possible recession, the latest jobless claims helped to send stocks higher and bond prices lower. Still, a lot of volatility and some apprehension about where the US economy is headed. We could still see more corrections and traders jumping off the ship by selling as prices climb again, while others quickly snap up bargains. Asian markets are also rebounding. Japanese stocks climbed today, tracking an overnight surge on Wall Street and bringing an upbeat end to one of the most turbulent weeks in Tokyo's market history. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please do send your comments. Again, thank you so very much for watching. Bye-bye.